Hey there, Investing Iguanas. Iggy here with a quick rundown of CapitaLand China Trust's first quarter business updates. Let's dive in and see what's been cooking in the world of retail and real estate. I will start by giving my overall summary, and then I will deep dive and decode their 8 key slides. Let's go. CapitaLand China Trust has seen some mixed results this quarter. On the bright side, retail mods are experiencing significant growth, with shopper traffic up 17.4% and tenant sales rising 12.6% year-on-year. That's a pretty impressive feat, considering the challenges faced by the retail industry. The company has also managed to reduce its gearing from 42.3% in September 2023 to 40.8% in March 2024, showing a positive trend in financial management. However, it's not all sunshine and rainbows. The largest logistics park lost a tenant due to business closure, resulting in a 0% occupancy rate. Ouch! Additionally, revenue dropped by $9.3 million for the new economy site, likely due to the bankruptcy of a major tenant. Despite these setbacks, retail gross revenue increased by 5.7% year-on-year, even after selling 2 malls. But here's the catch: net property income, NPI, decreased by 7.7%, and when considering SGD terms, it further dropped to 11.8%. Operationally, retail occupancy remained strong at 97.7%, indicating high demand for CapitaLand China Trust's retail properties. However, business parks are facing challenges with a 90.2% occupancy rate, as weak business sentiments and new supply put pressure on the sector. Management has taken steps to mitigate risks, such as converting SGD-denominated debt to RMB-denominated debt and maintaining an adjusted income coverage ratio of 3x. However, it's not all sunshine and rainbows. The largest logistics park lost a tenant due to business closure, resulting in a 0% occupancy rate. Ouch! Additionally, revenue dropped by $9.3 million for the new economy site, likely due to the bankruptcy of a major tenant. Despite these setbacks, retail gross revenue increased by 5.7% year-on-year, even after selling 2 malls. But here's the catch: net property income, NPI, decreased by 7.7%, and when considering SGD terms, it further dropped to 11.8%. Operationally, retail occupancy remained strong at 97.7%, indicating high demand for CapitaLand China Trust's retail properties. However, business parks are facing challenges with a 90.2% occupancy rate, as weak business sentiments and new supply put pressure on the sector. Management has taken steps to mitigate risks, such as converting SGD-denominated debt to RMB-denominated debt and maintaining an adjusted income coverage ratio of 3x. Shopper trends show double-digit growth in various sectors, including entertainment, 12.6%, and supermarkets, 14.2%. While retail occupancy slightly decreased, the majority of properties remain above 95% occupancy. Looking ahead, 40.3% of the retail portfolio leases are up for renegotiation, which could potentially impact rental rates. Business and logistic parks are also facing softer leasing demand and increased competition from new supply. In the broader context, China's economy grew by 5.3%, showing resilience in industrial activities. However, uncertainty regarding land lease renewals in the future may affect investors' confidence in the long run. Slide 1. The image focuses on the performance of CLCT's retail mall segment, which seems to be leading the recovery. Shopper traffic increased by a solid 17.4% year-over-year, indicating a rebound in consumer demand. Tenant sales also grew by an impressive 12.6%, reflecting improved spending. On the financial front, the company managed to keep its cost of debt stable at 3.47%, suggesting effective financing management. Even better, the gearing or debt-to-asset ratio decreased by a massive 40.8%, signaling reduced leverage. CLCT's asset portfolio is well diversified across retail properties, 75% of portfolio, 97.7% occupancy, business parks, 17%, 90.2% occupancy, and logistics parks, 7.1%, 67.6% occupancy. This diversification helps mitigate risks. Now, let's look at the numbers. CLCT's gross revenue for the first quarter of 2024 was 468.1 million Singapore dollars, a 1.6% increase from the previous year. This growth was driven mainly by the strong performance of the retail malls, offsetting weaker contributions from other segments. The net property income, a key profitability metric, stood at 313.1 million Singapore dollars, down 7.7% year-over-year. This decline was attributed to lower contributions from logistics parks and the absence of income from business parks. Overall, CLCT seems to be on a solid recovery path, with its retail malls leading the charge. The management's focus on debt reduction and portfolio diversification also bodes well for long-term sustainability. Slide 2. Looking at the operational updates for CapitaLand China Trust in Q1 2024, there are some positive signs amidst the challenges. Their retail performance got a boost from asset enhancement initiatives completed in 2023 at malls like Rock Square and CapitaMall Uwaiting. This helped the retail occupancy rate stay high at 97.7%, above market levels. Shopper traffic also saw a solid 17.4% year-on-year increase in Q1, indicating consumer demand is recovering well post-COVID. The business park segment maintained a stable 90.2% occupancy despite new supply entering the market. Their tailored leasing strategies for each asset seem to be working in attracting suitable tenants. In the logistics parks division, they successfully secured leases with key tenants at parks like Kunshan Baking and Wuhan Yangluo. Rental rates were also aligned with market conditions to stay competitive. Overall, CapitaLand China Trust appears to be navigating the challenges well by leveraging their diversified portfolio and proactive asset management strategies. Their focus on the resilient new economy sectors like e-commerce and technology is a smart move. I'll continue monitoring their performance, but the Q1 updates give reasons for cautious optimism about their prospects. Slide 3. The slide paints a picture of a healthy financial standing. As of March 31, 2024, the Trust's total debt stood at a manageable $1.86 billion, with a gearing ratio of 40.8%. This suggests a prudent approach to leverage, providing a comfortable buffer for investors. Additionally, the interest coverage ratio of 3.2x indicates a strong ability to service its debt obligations. One notable aspect is the impact of interest rate movements on the Trust's distribution. The slide outlines how a 50 basis point increase in interest rates could potentially reduce the distribution per unit by 0.9 cents for SGD loans, while a 50 basis point decrease could boost it by 1.0 cent for RMB loans. This information is crucial for investors to understand the Trust's sensitivity to interest rate fluctuations and how it may affect their returns. Overall, CapitaLand China Trust's financial position appears robust, with a diversified portfolio of retail, business park, and logistics properties across China. However, investors should keep a close eye on factors such as currency fluctuations, interest rate movements, and the overall economic conditions in China, as these could impact the Trust's performance. As always, conducting thorough research and aligning investments with your risk appetite is key to successful investing. Slide 4. This slide provides a comprehensive overview of the Trust's debt structure, highlighting its impressive ability to manage its financial obligations without the need for refinancing until 2025. The key takeaway is the Trust's proactive debt management approach, where it has strategically termed out its RMB loans at a lower interest rate, ensuring a more favorable financing cost in the coming fiscal year. Additionally, the Trust's debt portfolio is well balanced, with a mix of RMB-denominated debt, 23%, SGD-denominated debt, 77%, and a combination of fixed rate, 75%, and floating rate, 25%, instruments, which helps mitigate interest rate risks. Furthermore, the Trust has managed to increase its RMB-denominated facilities from 20% in December 2023 to 23% by March 2024, demonstrating its ability to access local currency funding and optimize its capital structure. Notably, the trust has also increased its sustainability-linked loans, which now account for 36% of its total loans, aligning with the growing emphasis on sustainable financing and responsible investing practices. Overall, CapitaLand China Trust's well-staggered maturity profile and proactive debt management strategies position it favorably to navigate potential market volatility and capitalize on growth opportunities in the Chinese real estate market. Slide 5. The key highlight is CapitaLand China Trust's focus on enhancing portfolio stability through broader diversification. This approach reduces exposure to tenant concentration risks. The retail segment dominates at 70.4%, followed by a well-diversified business park segment at 26.8%. Within business parks, the portfolio spans electronics, engineering, IT, biomedical sciences, and other trades. This diversification strategy strengthens CapitaLand China Trust's resilience by minimizing overdependence on any single tenant or industry. A prudent move, especially in today's volatile market conditions. The data also shows the trust increasing its exposure to specialty retail and services, indicating proactive portfolio management. From an investor's lens, CapitaLand China Trust's diversified approach to portfolio construction aligns with our principles of mitigating risks and pursuing long-term sustainability. Slide 6. From the slide, we can see that CapitaLand China Trust had a healthy retail retention rate of 60.9% for renewed leases in Q1 2024. This is a significant improvement from 35.4% in the previous quarter, indicating better tenant retention and stable occupancy rates. Additionally, the majority of malls recorded positive rental reversions, suggesting the REIT's ability to negotiate favorable lease terms. The slide also highlights CapitaLand China Trust's increased exposure in targeted sectors generating higher sales. The food and beverages category takes the largest share at 43.5%, followed by leisure and entertainment at 11.7%, and fashion and accessories at 11.2%. These sectors are likely benefiting from the post-pandemic recovery in consumer spending as people return to physical retail spaces. Overall, the portfolio's occupancy cost appears to be within a sustainable range of high teens to low 20%, indicating prudent management of operating expenses. Slide 7. From the slide, we can see that CapitaLand China Trust has a well-diversified portfolio, with a significant chunk of its assets allocated to business parks, contributing a solid 17% to their overall portfolio. Now, this diversification is key because it helps mitigate risk and ensures a steady stream of income, even if one sector experiences a downturn. But wait, there's more. The slide also highlights CapitaLand's proactive approach to tenant engagement and customized leasing solutions. They're not just sitting back and waiting for tenants to come knocking, they're actively pursuing them, both globally and domestically, to expand their client base. Talk about hustle, and let's not forget about their asset-specific leasing strategy. CapitaLand is implementing customized leasing approaches to capture demand from tenants in their Ascendus Shinsu portfolio. This includes targeting international and domestic tenants, securing renewals, and retaining tenants poised for robust growth in sectors like electronics and engineering. It's clear that CapitaLand China Trust is playing the long game here. They're not just focused on short-term gains, but are positioning themselves for long-term success by diversifying their portfolio, actively engaging with tenants, and adapting their strategies to capture emerging market trends. Slide 8. Now, while the logistics segment only makes up 7.1% of the portfolio, there are some concerning trends we need to discuss. The occupancy rates for their Grade A logistics facilities in Shanghai and Kunshan have taken a hit, dropping to 82% and 80% respectively. This decline can likely be attributed to the challenging macro environment in China, with supply chain disruptions from the zero-COVID policy impacting economic activity and tenant operations. To address this, CapitaLand China Trust is implementing customized leasing strategies like adjusting rents to retain existing tenants and attract new ones. They're also leveraging their property's proximity to major transportation hubs as a selling point. However, with increased market supply and softening demand, maintaining healthy occupancies and rental rates will be an uphill battle in the near term. While the logistics segment is a relatively small part of the portfolio, its performance could serve as an early indicator of broader economic headwinds impacting CapitaLand China Trust's other operating segments. As investors, we'll want to keep a close eye on how management navigates these challenges and pivots their strategies accordingly. Staying invested for the long haul requires carefully evaluating both the risks and opportunities at play. Alright, Investing Iguanas, that wraps up our analysis of CapitaLand China Trust's Q1 FY24 results. As we've seen, there are some bright spots, like the growth in retail mods and the reduction in gearing. But we can't ignore the challenges, such as the loss of a major tenant in the logistics park and the drop in revenue for the new economy site. It's crucial to keep a close eye on these developments and adjust our investment strategies accordingly. If you found this video helpful, be sure to smash that like button and subscribe to the Investing Iguana channel for more financial insights and analysis. Remember, investing is a wild ride, but with the right knowledge and a bit of iguana intuition, we can navigate these markets together. Until next time, stay savvy, stay invested, and keep on iguana ing.